pulled forward that thinking. Peaking global growth and the slow journey of Fed normalization should see the dollar grind higher versus most major currencies. So they are talking about the dollar being positively correlated, positively correlated to a peaking of global growth and a slow normalization of Fed. In other words, the Fed lagging perhaps behind the RBA, perhaps the Fed lagging behind a little bit of the Bank of England. That would tie in with what Westpac's view was, wasn't it? So perhaps that's something that people could start to get a little bit of an insight into when they're watching these ideas. Timing is nearly everything. Well, in a lot of cases, it nearly is everything. Since late last year, we've advocated that a weaker dollar would be consistent with an improving global economic outlook. See how that relationship is something we talked about this morning as well. We talked about that weird, wonderful relationship that the dollar has, that obviously if the world economy is improving, that the 2-10s curve starts to boom in the US against the UK and against the likes of Australia, then of course the US dollar can improve. But obviously, as what these guys are saying here is that the US dollar would be consistent with a weaker US dollar would be consistent with an improving global economic outlook. It's a little bit that weird relationship that the dollar has with growth, because if dollar's always been used as a safe haven, then of course as that safe haven unwinds, the dollar starts to the dollar starts to the dollar starts to weaken, of course. However, we've also said that the dollar has already declined meaningfully in 2020, and so this year's weakness should be limited in scale and duration. The US dollar would slowly begin to recover versus major currencies, including the RMB, later this year. There are two important reasons to explain this framework. First, the peaking of global growth sequentially would mark the end of the dollar's broad cyclical decline. Second, the Fed's path towards policy normalization should support the dollar gradually, especially when tapering actually starts. In other words, the HSBC are looking at taper as a sign, of course, and that wouldn't be surprising. I think everybody would expect that that would be normal. If the Fed starts tapering, the dollar's going to gain some upside, right? It's pretty obvious. These points have underpinned our view of a gradual dollar recovery, but the timing is wrong. Interesting, right? The timing is wrong. Instead of these two forces slowly supporting the dollar later this year and into 2022, this is happening earlier. As a result, we've pulled forward the timing of the dollar to strengthen and expect this to continue through 2022. We first pushed back against the idea that the hawkish Fed meeting in June as the specific catalyst. Fed funds futures had already discounted what the FOMC's median dot suggested, i.e. a plus 50 basis points come H2 2023. So they're looking at the Fed funds futures and looking at where their forecasts are against where the Fed are talking about, just to get some sort of a confirmation that the Fed funds futures are looking at 50 basis points H2 2023. Now, what I hope you guys do when you see things like this is go away and plot the dots plots. Go away and do it. So how do you plot the dots plots for the Fed funds futures? Well, you can't do it in a 5-minute chart, that's for sure. So what you've got to try and do is you've got to go into the daily chart, right? You've got to go into the daily chart and do 100 minus, and obviously look for the Fed funds futures, which is ZQ, right? So you can look for ZQ and you can come up with an idea on a daily chart where the ZQ is. You can see that this is the Fed funds futures on a contract 1. So this is 100 minus ZQ1. This is the Fed funds futures front month. Now, obviously, once you've got that number, you can see where the current Fed funds futures are, but the difference is you can actually now work out all the other Fed funds futures, can you? So when you go to compare and you put in 100 minus ZQ, you'll be able to then click on the ZQ and you'll be able to choose whatever month you want to look at. So if we look at, for example, if we go out to August 22, or if we go out to 23, if we go out to August 23 or even July 23, we could start looking at 2 years in advance to see what they currently would be suggesting in terms of the Fed funds dots plots. And this is the dots plots. This is what the dots plots looks like, right? So when we click on that one, and then we change it back, and we put the labels back to, we put the regular back on, you can start to recognize the dots plots. Sorry guys, I haven't done 100 minus, that was a problem, my mistake. And this starts to show you the dots plots, because look at what's happened. The dots plots have rallied, haven't they? Quite significantly so. You can start seeing the dots plots are going from this level, and you can see that this August 2023 dots plots is actually improving quite a lot. So we can start recognizing how much interest rates are expected to go up against what the Fed's talking about. So the high print just now is 65 basis points. The current print just now is 10 basis points. So what's the difference between 10 basis points and 60 basis points? 50 basis points, right? So the difference between these two is 50 basis points. So when you understand that that's the difference between the two, and then you go back to that story that we've just been talking about, we go back to that storyline from HSBC, we can recognize, of course, that according to HSBC, they were talking about 50 basis points plus 50 basis points come H2 2023. So in other words, you've got the ability to know this stuff. And a lot of people, when they start looking at these, they get overawed by the amount of information, the amount of stuff they're talking about. You can chart pretty much everything that these guys mention. You can confirm it, you can look at it, you can understand it, you can process it, and you can almost look at these things and just go, you know what, that's exactly what I would say. I think that August 2023, there's 50 basis point rise. That's 2 interest rate hikes by the Fed at that stage. The first of which, of course, we're going to be starting to look at, and you can start working your way through, because obviously this is August 2023 that we're on here. So this is the August 2023 Fed. But obviously you can start working your way through this to try and find out, well, when is the first interest rate hike expected? So we can obviously go back into our comparison again, and we can just keep that process going. So we can do 100 minus ZQ, Z 2021, and we can look at what the expectation is for December 2021, December 2021s, can't we? We can start looking into those areas. We can start looking into those types of numbers. We're looking for those elements, aren't we? So when we're looking for those elements, sorry guys, I don't know why it's not letting me do the 100, and I've got to keep changing it. It's a pain in the arse. So when we look at 100 minus ZQ, you can see that's not when the first interest rate scheduled, is it? If we look at 100 minus ZQ, going back to going out to December, we could already recognize that there is no interest rate forecast expectation for December. Otherwise, this would be up quite significantly, wouldn't it? But it's not up significantly. In fact, it's not up at all. We can see it's not even up at all, is it? It's actually trading at a slight discount at the moment, a slight discount to the current rate. And that's obviously in telling us that there is no way the Fed is going to be raising interest rates anytime soon. Now, this is the actual rising rates, of course. This is when we're starting to think about it. So when does it go up? When do we start seeing some positive progress? Well, let's look into 100 minus ZQ. Let's do Q 2022. And now we can start to see something, can't we? We can start to see that Z 2022, it was suggesting that we were going to be moving up to the upper bracket of the 25 basis points. This is this yellow line that you can now see on the charts here. It nearly makes it to 22 basis points, not quite, 25 obviously to get above into the top half. And remember, we always talk about one of the most important levels being the 12.5 basis points. Why? Because if it's in the 12.5, it's expected to rise. If it's in the 12.5, it's expected to rise. If it drops below the 12.5, it's expected to fall. So we can see, obviously, when we got this big change to the downside here, not surprising, of course, that the high print at that stage was 66.5 and it dropped down to 40. So that's taking one interest rate hike out at that stage. And they've obviously put that interest rate hike back in again. Well, that's because that dropped below the zero here, the 12.5 here, and it's went back above the 12.5. So they've put that interest rate hike back into the market. So we can see that these storylines, and it goes on to explain, and this is a very, very long report on the dollar, and I'd like to go into more detail on this because obviously they talk a lot about the market here in terms of the dollar and its the cyclical nature of the dollar and things like that. It's a very, 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 very deep report. The HSBC, it's not a one-page, as you can see, it's not a one-page report that HSBC go into, but you know, obviously we'll hopefully remind ourselves to keep that for tomorrow, and we'll maybe go through the HSBC report tomorrow at some stage during the day. Classroom guys, in 5 minutes, we're going to be doing the STI report on, we'll do the STI report on the S&P. We'll look into what they're saying about the S&P and about why they think we're going to be get a 10% correction. And that's at 4 o'clock, guys, 4 o'clock.